For April 23rd, the market delivered a clear message. AI exposure is no longer a guaranteed lift. U.S. equities faced broad pressure, with the S&P 500 falling 0.41%, the NASDAQ down 0.89%, and the Dow slipping 0.36%. But beneath that weakness, the tape showed a sharp rotation. Investors are aggressively differentiating, rewarding physical AI hardware while applying stricter scrutiny to software margin models. On April 23rd, the market delivered a clear ultimatum. Simple AI exposure is no longer enough to drive valuations. Investors are actively separating winners from laggards, showing a distinct preference for physical infrastructure and data center demand. Meanwhile, software providers are being held to a much stricter standard. They must now prove that AI feature sets can drive incremental revenue without eroding their core margin models.
ServiceNow is the cleanest warning sign. It reported strong first-quarter growth and raised full-year subscription revenue guidance to $15.735 to $15.775 billion. The stock still fell 17.75%. Investors focused on the margin outlook, Middle East deal delays, and whether AI demand is showing up fast enough in the numbers. In this market, a beat can still get punished if the future margin story looks cloudy.
IBM's results show the disconnect currently haunting software. Revenue climbed 9% to $15.9 billion, with software and infrastructure segments both posting double-digit gains, while operating EPS hit $1.91. Yet the stock fell more than 8%. The market has moved past simple profitability questions. Investors are now scrutinizing whether software growth can re-accelerate in an environment where AI is fundamentally changing customer budgets, pricing models, and workload requirements. That is the harder proof standard for software. It is no longer enough to claim AI will help customers work faster. Investors now demand clarity on who owns the budget, who covers the compute costs, and who protects gross margins. This does not mean the sector is broken, but it does mean the market is forcing software companies to demonstrate AI revenue growth and margin discipline simultaneously.
On the other side, Texas Instruments provided the market with a much clearer hardware story. First-quarter revenue hit $4.8 billion, up 19% from a year earlier. The real standout was data center revenue, which grew about 90% year-over-year and over 25% sequentially. With management guiding for second-quarter revenue between $5.0 and $5.4 billion, the market had the evidence it needed. Investors sent the stock up 19.43% as a direct reflection of this infrastructure demand.
After the close, Intel delivered a mixed signal that tests investor conviction. Revenue reached $13.6 billion, up 7%, with data center and AI revenue jumping 22% and foundry revenue up 16%. Non-GAAP earnings per share rose to 29 cents from 13 cents a year ago. However, the GAAP results tell a different story, showing a 73-cent loss. The coming session will determine if the market's appetite for AI infrastructure growth is strong enough to look past this restructuring noise. The macro backdrop did not give investors a clean pass. S&P Global's flash U.S. Composite PMI rose to 52.0 in April from 50.3 in March. The improvement was helped by stock building as companies worried about supply availability and price hikes tied to the war. That makes the growth signal less clean. Some of it may be precautionary buying, not fresh demand. On April 23rd, the market was caught between two forces: solid earnings in one hand and mounting geopolitical inflation risks in the other. As hopes for a quick Iran deal faded, oil prices held near $100 a barrel, while persistent war headlines weighed on sentiment. In the end, these macro pressures proved heavy enough to pull the major indexes lower, even as specific pockets of hardware strength managed to hold their ground. The energy story matters because it feeds directly into margins. Elevated crude prices, shipping uncertainties, and rising input costs are weighing on transportation, manufacturing, and food supply chains. This pressure often prompts companies to pull orders forward, which can temporarily flatter near-term activity, but risks creating an air pocket later. It captures the macro tension defining today's earnings, strong headline numbers tempered by a challenging cost environment ahead. But it is critical to keep this in perspective. We are not seeing an earnings collapse. Through the morning of April 23rd, over 82% of the 123 S&P 500 companies that had reported were beating their estimates, with earnings growth holding strong at 15.6%. The market isn't simply rejecting risk, it is actively sorting it. Companies that can demonstrate visible demand and defendable margins are still getting the benefit of the doubt.
Our narrow path forward is clear. For software, watch gross and operating margins, deal timing, and evidence that AI is actually driving incremental revenue. For hardware, stay focused on data center demand, supply chain stability, and company guidance. On the macro tape, keep a close eye on oil near $100, geopolitical headlines around Hormuz, and whether PMI strength reflects genuine demand or is just inventory frontloading. April 23rd was not a rejection of AI. It was a day of AI differentiation. Hardware names with clear, measurable infrastructure demand were rewarded, while software names facing uncertain AI economics were marked down. As long as geopolitical risk keeps oil prices elevated, the bar for earnings beats remains high. Growth alone is no longer enough. The market now demands growth that can survive the pressure of rising costs.